A company you may have never bought before could soon become one of the most controversial IPOs of the year. It is called Quantinuum. It is backed by Honeywell. It is trying to go public under the ticker QNT. And here is the number that should make every investor stop and think. Quantinuum is targeting a valuation of up to roughly $12.7 billion on just $30.9 million of revenue last year. That is not a typo. This is either one of the most important quantum computing opportunities of the decade or one of the most expensive stories Wall Street has ever tried to sell. In this episode, we are going to break down the Quantinuum IPO like a real investor. Not hype, not fear, just the business model, the S1 numbers, the competition, the valuation, the risks, and the final question. Should investors chase this IPO on day one or wait for a better entry? Quantinuum was formed from the combination of Honeywell's quantum computing business and Cambridge Quantum. That matters because this is not a random startup trying to ride the AI wave. Quantinuum has industrial roots, deep research credibility, and a full-stack quantum platform. The company works across quantum hardware, quantum software, cloud access, cybersecurity, chemistry, machine learning, and advanced research applications. And unlike many private IPO candidates, Quantinuum has already filed publicly. The company plans to sell just over 21 million Class A shares at an expected price range of $45 to $50 per share. The proposed ticker is QNT, so this is not just a watch list name, this is a real IPO event. Quantinuum's business is best understood as a full-stack quantum company. On one side, it builds quantum computing hardware. On another side, it offers cloud access, research services, support services, and software tools. The company's 2025 revenue came from two major areas. First, specialized quantum computing hardware. Second, cloud platform, research, and support services. This is important because Quantinuum is not yet a clean software subscription business. Revenue can be lumpy. Large hardware transactions can make one quarter look much stronger than another. And that's exactly what we see in the filing. In 2025, revenue was $30.9 million. That was up 35% from $23 million in 2024. On the surface, that growth looks good, but the loss profile is huge. Quantinuum lost $192.6 million in 2025. Adjusted EBITDA was negative $171.2 million. Operating cash burn was also significant. The good news is liquidity. As of March 31, 2026, Quantinuum had about $677 million of cash and equivalents. And after the IPO, the company could have more than $1.6 billion in pro forma adjusted cash if the offering prices near the midpoint. That means this IPO is not just about giving early investors liquidity. It's also about funding a very expensive technological roadmap. Quantum computing is not cheap, and Quantinuum is still in the phase where the science, the engineering, and the business model all need more capital. Here is where the story becomes controversial. At the top of the IPO range, Quantinuum could be valued around $12.7 billion. Against $30.9 million of 2025 revenue, that's roughly 411 times trailing sales. For context, even very expensive software companies usually don't trade anywhere near that level. So, investors are not paying for current revenue. They're paying for the possibility that quantum computing becomes a strategic platform over the next decade. This is not a valuation based on earnings. It's not a valuation based on near-term cash flow. It's a valuation based on technological optionality. And that means the stock could be extremely volatile. So, how does Quantinuum compare with other quantum names? IonQ is probably the closest public comparison because both companies use trapped ion technology. IonQ is already public, and its 2026 revenue guidance is far above Quantinuum's current revenue base. That makes IonQ look more commercially advanced today. D-Wave is different.
It is known for quantum annealing, and it trades more like a specialized quantum pure play. Rigetti focuses on superconducting quantum processors, but it has faced questions around revenue scale, delays, and the cost of building hardware. Then you have IBM and Alphabet. These are not pure-play quantum stocks, but they have deep research teams, massive balance sheets, and the ability to fund quantum development for years without depending on public market enthusiasm. That is the competitive problem for Quantinuum. It is more focused than IBM or Alphabet, but it is also much smaller, much less proven commercially, and far more dependent on investor belief in the future of quantum. Now, let's build the bull case. First, Quantinuum is not just a single product company. It's a full-stack quantum platform. That gives it multiple ways to win: hardware, cloud access, software tools, cybersecurity, chemistry, and enterprise research. Second, Honeywell remains deeply connected to the company. That gives Quantinuum more industrial credibility than many early-stage tech IPOs. Third, quantum computing is becoming strategically important. Governments and large enterprises care about encryption, national security, advanced materials, drug discovery, optimization, and AI acceleration. Fourth, the IPO could give Quantinuum a very large cash balance. That cash matters because quantum computing requires years of research and development before the biggest commercial markets arrive. So the bull case is simple. If Quantinuum becomes one of the few real winners in quantum computing, today's revenue will look almost irrelevant in hindsight. The market is not buying what Quantinuum is today. It is buying what Quantinuum could become. But the bear case is just as powerful. First, the valuation is extreme. 400+ times trailing sales leaves almost no room for disappointment. Second, losses are large. Quantinuum lost nearly $193 million last year on just $31 million of revenue. Third, revenue quality is still hard to underwrite. Hardware deals can be lumpy, research contracts can be uneven, and the market for practical quantum applications is still early. Fourth, competition is intense. IonQ has more revenue visibility. D-Wave and Rigetti are already trading and already absorbing public market volatility. IBM, Alphabet, Microsoft, and Amazon have the balance sheets to keep investing even if the quantum market takes longer than expected. And fifth, public shareholders may own only a small economic slice immediately after the offering. That can create governance and liquidity questions, especially if insiders and existing holders retain significant control. So the bear case is not that Quantinuum is fake. The bear case is that Quantinuum may be real, but still too early and too expensive. If Quantinuum starts trading, I would watch 5 things before making a serious decision. Number 1, first-day pricing. If the IPO prices above range and opens with a huge pop, valuation risk increases immediately. Number 2, quarterly revenue quality. Is growth coming from repeatable cloud and software usage or one-time hardware and research contracts? Number 3, bookings. Bookings need to become more consistent if investors are going to believe in future revenue growth. Number 4, cash burn. The company can raise a lot of cash, but quantum development can consume cash quickly. And number 5, commercial customer traction. The big question is not whether quantum computing is exciting. The big question is whether real customers are willing to pay meaningful money for it today. So, what is the final verdict? Quantinuum is one of the most interesting IPOs in the market right now. It has real technology, it has Honeywell behind it, it has a serious quantum narrative, it has a public filing, and it could become the first major traditional IPO pure play in quantum. But for most retail investors, I would not treat this as a normal growth stock. This is a high-risk, high-duration technology bet. At the IPO price range, the market is already pricing in enormous future success. So, my view is this: Quantinuum belongs on the watch list. It may deserve a small speculative allocation for investors who understand quantum risk. But chasing a massive first-day pop would be dangerous. The smarter approach is to wait for the first earnings report, study revenue quality, monitor bookings, and see whether the company can turn scientific credibility into repeatable commercial demand. Because in IPO investing, the story gets attention, but the numbers decide the return. Now, I want to hear from you. Would you buy Quantinuum on IPO day, or would you wait for the first earnings report? Comment QNT if you want a follow-up breakdown after the stock starts trading, and subscribe because every time a major IPO filing drops, I'll break down the S1 line by line.